Okay, Chapter 13, Part 2 here, we're on slide 19. Issuing stock for non-cash assets. This is actually fairly common. Many times companies will, or investors might invest real estate, maybe buildings, maybe equipment, patents, copyrights, trademarks, in lieu of cash. And they in turn, the company might buy these assets using stock rather than money. And it's not uncommon for companies to buy other companies using stock rather than cash. And so here's an example. They're just using land. So you just simply use the asset account of land for the $2.5 million. But you still do the same thing. The $2 par value for 200,000, i.e. there's 100,000 shares here for the $2, and then the paid in excess of par value, the 2.3. So it doesn't have to be cash. Cash dividends. Regular cash dividends provide a return to investors and almost always affects the stock's market value. In finance, there's many views on this. Some fast-growing companies typically don't want to pay cash because cash is too valuable. They want to use it inside their operations rather than have to borrow it or raise more stock. So fast-growing companies usually never pay dividends. Very mature companies often do. And there's also some philosophy between companies to position themselves to appeal to certain types of investors. Certain types don't want dividends, other types of investors do. So companies will try to align themselves to certain investor groups. And so paying dividends is common, but not universal. So a couple things have to be necessary to pay a dividend. A sufficient balance in the retained earnings, otherwise it would be a return of capital. So there has to be some net earnings in the balance sheet. And then the cash has to be necessary to pay the dividend. There must also be a third thing, which they're not saying. It has to be approved by the board of directors. Okay, that's the third component. And here they have a chart of how many companies are paying. These, I think, are of publicly traded companies. Most privately held could be totally different. So I think this is just a publicly traded market here. So, when accounting for cash dividends, there are 3 dates that you have to be aware of. The date of declaration. This is when the board declares they're going to pay a dividend. And that's the day you have to record a liability for the dividend. And it'll be simply dividend payable, as an example. Date of record. This is if you're a stockholder as of this day, you are entitled to this dividend. No entries required here. This is handled by the corporate register who keeps track of the shareholders in the stock. So there is no accounting entry. And then the actual day of payment. See, the board might declare it on the 1st of the month, but you might not pay it till the end of the month. And so these are the different days that are, and they're very distinct. And so this is when they're going to pay the stockholders who own the stock as of this day, not of this day. And there are some investors that buy before the date of record and then immediately sell afterwards. And even if they only own stock for that one day, they get that dividend payment if they were the holder of that day of record. So there is some manipulation in the market sometimes to account for this. So an example here, on January 19th, the board meets and they authorize to pay $1 per share cash dividend on the 10,000 shares outstanding, and it will be paid on March 19th to the stockholders that own it on February 19th, not February 18th, not February 20th, just that day. But this is the day of declaration. This is when the board declares it. Here you have to declare or record this liability. And so you're taking it out of retained earnings. It's the only place it can come out of. And then it's common dividend payable. It could be also preferred dividend payable. for other stocks. But this is, it's a payable. Later on, we're going to go ahead and credit cash to pay this payable, and that will be on March 19th. Okay, so February 19th, the date of record of payment of cash to stockholders. So again, there's nothing that the accountant here has to do on this day on February 19th. But on on March 19th, they now go ahead and pay it. And so you debit the payable, and you obviously subtract out your cash to pay that dividend. So companies don't always make money, and they can go into a deficit. So an example would be, look at Ford there in 2008, 2009. They were billions of dollars in the hole. No dividends can be paid. So dividends can only be paid out from this retained earnings. And if there's a deficit, you can't pay. You've got to rebuild this up and have it positive before you can start issuing dividends. Stock dividends. Yes, to make things more confusing, sometimes companies pay in stock rather than in cash. And it's sort of a gimmick, to be honest with you. But stockholders feel like they're getting something of value, but at the same time they're just diluting the value of their stock. But that's not how many stockholders see it. So, so sometimes management will try to give the impression that things are good, and so they're just going to issue more stock to this current stockholders, but no money. So again, small stock dividend if it's less than 25%. If it's over 25%, it's considered a large dividend. So stock dividend, how would you do this? So they're going to pay $1, and so how they're doing it is the 10,000 times the 2%. So they're declaring a 2% stock dividend. So they're going to pay 2% of this $100,000 par value here. It's $2,000 times 10 is 20,000. So it's 20,000. Again, the par value is 2,000, and then the excess amount is 18. You're taking it out of retained earnings. And then you notice that the stock went up. Then 250,000 shares issued and outstanding, paid in excess. And so it's going up here. You can see that they're adding the 2,000 shares now. Here's your 2,000 shares. You have 102 now. Paid in excess is going up. And so, and the retained earnings went down by that 20,000 because before it was 35, and now it's going down because you paid the 20,000. I'm not going to go into a large stock dividend. Stock splits. Often, not often, but there are times when the board of directors decides to split a stock. And understand, a lot of people think that it splits only one way. That's not true. You can have a split like for 2-for-1. That means if you own 1 share today and we do it 2-for-1, you now own 2 shares. But don't think you're getting money out of nothing. You have 2 shares at half its value that it was the 1 share. And so you can't print money. You can also do what's called the reverse split, whereas if you owned 10 shares, now you own only 5. But your par value and everything doubled. So it can go both ways. And so here they have $10 par value and 100 shares, and then they issued, now you have 200 shares at $5. 5 times 200, right? 1,000. 10 times 100, 1,000. So the value on the balance sheet hasn't changed, but how much you're going to put in the notes saying how much stock has been issued will change. It can get a little confusing. There's a lot to stocks, as you can see. So again, a reduction in par value or stated value could be an increase if you're doing a reverse split, and then you're increasing the number of shares. A stock split does not have any effect of the total paid-in capital or retained earnings and stockholders' equity, but it does affect the number of shares issued. You have to record that. So you don't really, it's not necessary to journalize a stock split. there was really no financial transaction. Preferred stock. So there are basically two types of stock: common stock and then preferred stock. It's a separate class of stock and typically having priority rights over the common shares. Hence it is preferred. It has preferential rights is what it's saying. And those preferential rights is it gets paid its dividends before the common shareholder does. So it has dividend preference. And in case if there's a bankruptcy or the company sells or something like that, any distribution of assets in case of liquidation, they get distributed before the common shareholder. So it is it's viewed as a safer stock. It's higher on the balance sheet, as we'll show how it's positioned. And it typically has a stated dividend rate. A preferred stock often acts like a bond. It's reflected in the equity component of the balance sheet, but it has some qualities of that of a bond. And one of them is it has a stated dividend rate. And this is a stated rate that's going to be paid even if the company made $1 million or $100 million, that's the rate it's going to get paid. So it really doesn't share on the upside potential like a common stock. And they say corporations with no preferred stock is 73%. I have a feeling that's publicly traded. A lot of privately held companies do, and then maybe 1/4 of the companies do have preferred stock. Another negative to it: normally a preferred stock has no voting rights. That's only normally. For instance, I do a lot in the financial structure of corporations. I've been a CFO and I have funded some startups. And if I'm an investor, and sometimes I have representative investors, I always take voting rights, even though I have preferred. This is negotiated. It might not be as prevalent in publicly traded companies, but in privately held, we take voting rights. So don't think this is absolute. Oh, this is going to get confusing again. So preferred stock, cumulative versus non-cumulative. Again, I apologize, there's a lot of terminology in this chapter. You need to slow it down, and I would strongly suggest studying this vocabulary. So dividends in arrears. So what that is saying is, let's say a dividend has been, a preferred stock, as an example, gets paid $1 a year. Well, they can only really pay it if there's the retained earnings. What if the company was losing money and was incapable of paying that dividends, or the board simply decided not to pay the dividends? Again, dividends are not automatic. They have to be decided. Well, a lot of preferred stocks have a cumulative term feature written into their agreement. And what cumulative says is any dividends that has been missing now has to be paid first before any other common shareholder gets any more dividends. I always negotiate cumulative, but some preferred have non-cumulative. And so the undeclared dividends from prior years do not have to be paid. They're just simply lost. So it's a much stronger advantage for the preferred to get this. So you might ask yourself, why don't all preferred stock ask for cumulative? These are negotiated. Some corporations are in a very strong position, and these are terms that they're not going to offer, whereas other companies are in a weaker position, and they do entice investors by offering these terms. So there's a lot of slicing and dicing that goes on in these negotiating tables, and these are one of the things that is negotiated, as well as the voting rights or no voting rights. So if you did not declare a dividend, and the board declared, if you did not pay a dividend in 2012, then in 2013 paid dividends, well, the par value states here, and here's your 40,000 shares, so here's your 200,000, representing 200,000 divided by 4 equals the 40,000. You notice they get 9% of $100 par value, so what's 9%? It should be $9, right? 1,000 shares authorized, issued, and it's outstanding. And so 1,000 times 100 is 100,000. Total paid in capital is the 300,000. Now this 9%, what if they didn't pay that in 2012? So that means they're missing this $9,000 payment. Well, if it's in cumulative, they now are going to get that. And so in 2012, the preferred gets paid at $9,000, and then the remainder goes to the common. But here in the cumulative, because that was non-cumulative, so they missed this one payment. Whereas the cumulative, they get that past payment, and then the common gets paid. So it's much stronger to have the cumulative feature in your preferred term agreement. I'm going to stop here, and we're going to start part 3.